So everybody knows that 2 plus 2 equals 4. But when it comes to buying a business, how do you know whether you're valuing a business the right way or not? Have you ever looked at a business for sale and been like, hey, is that a gold mine or a dumpster fire? Today, I'm going to talk you through how to go about analyzing and valuing a business without needing a finance degree and a Wall Street resume. So let's go ahead and break it down like that cash flow statement that you've been putting off. Now, the first type of valuation method is one that's based on the income that the property ultimately generates. Now, when I say income, I'm not necessarily talking about the revenue numbers. What we're actually talking about is the cash flow that the business ultimately is going to generate. And in businesses that are in, call it the sub $10 million revenue range, what we're most likely going to be using is what's called SDE, or seller's discretionary earnings. And what the seller's discretionary earnings represent is the net operating income of the business, and then adding back in the owner's salary, as well as any additional one-time expenses or things that are not realistically going to occur when you take over as the business owner. Be careful if you're looking at brokered businesses. They are going to try to put in these add backs for a lot of different things. As we start getting into, maybe the higher end of that range, or in certain businesses, like basically when you start getting like an actual management layer in place. And that's when we get to kind of the like similar, but sort of different approach to multiple, which is the EBITDA, or the EBITDA, if you're not familiar, is earnings before interest, tax, amortization, and depreciation, is what EBITDA stands for. And basically what that references a lot of times is when there is like a management layer in place that you're paying their salaries, then you're not going to be removing those salaries adding back those salaries. There's a third model that can be used in like high growth-ish areas and things along those lines, which is the discount cash flow model. So you're basically doing like a projection of future revenues and basically trying to back that into like, hey, what should I pay today based on what's there? But the thing is like, you can make any business look like it's freaking Google if you do Enron style accounting, right? Like, so the biggest thing with discounted cash flow models is like, you want to really be careful about what you're putting in, especially if you're going to be like raising capital from investors or anything along those lines, that you're putting in realistic expectations that you're going to be able to achieve and you're going to be able to hit. The next piece is kind of like the sort of equivalent-ish of just like looking at market comp data, right? So if you're used to buying real estate, like you go and do pull comps reports and things along those lines. And there is, some databases out there that people will report business sale transactions to. It's not as publicly available as like real estate transactions are recorded, but peer comps and IBBA, the International Business Brokers Association, have databases that you can either buy into and things along those lines to like see the transaction history. And they'll give you kind of like size, scope, earnings, things along those lines, and what they've sold for, so that you can kind of like back into different industry multiples. The kind of like next way of valuing a business is going to be the asset-based way of calculating the value of a business. So on the most simple level, you're going to look at the balance sheet, you're going to basically take the assets and you're going to subtract out the liabilities, and then you're going to say like, hey, here is what the business is worth. Now, you're most likely going to end up using this kind of a scenario with businesses that have a lot of assets, whether it's inventory, machinery, different things along those lines. And especially if they're, in some sort of a distressed situation, right? So you're not going to be able to necessarily buy it off of a multiple of cash flow. You're basically buying it for what sometimes might be referred to as the liquidation value of the business. Another kind of way that you might, work into this is like, if it's, again, such an asset heavy business, you could also get it where like, again, when you book assets on your balance sheet, you book them at like the current valuation, and not all business owners necessarily are, changing their asset values based on market, right? So you may have these assets that are sitting there and you need to bring in new debt, to finance that, right? Like you're basically going to be looking at this kind of like revalued version. So this video is already helping you kind of like get your head out of the fog of how to go about potentially valuing a business. Then go ahead and like and subscribe to the channel. So now that you've hopefully kind of like gone through like these different valuation methods and you've kind of like picked like maybe like one or two of them that you're like, hey, I want to like play around with these to see what actually is going to be. Now you're actually going to like need to like dive in and actually look at the financials in order to be able to kind of back into what's most likely going to be there. So the two that you're most likely going to be looking at, you know, are the income statement, the P&L, and the balance sheet. There's some other factors to realistically ultimately consider here. Like, so on the income statement, we've already kind of talked about like sometimes, you know, there's add backs and things like that. And so like you could be looking at like, is the seller running their car through there? Are they running their boat? Being able to understand those adjustments is one thing, but it's also important, for example, to look at some of the other financial metrics. So things like looking at their cash flow statement, looking at their sales history reports, because there's a big difference between a business generating $1 million revenue, but 80% of that revenue is coming from a single client. That's a heavy client concentration risk, which can actually devalue a particular business. Similarly, you know, if you have a heavy cash conversion cycle or a long cash conversion cycle where, you know, you're having to provide services, but you don't get paid until 60 or 90 days later, understanding that cash flow of your business, looking at the cash flow projection, that could significantly impact the offer that you're going to be able to make, because you're going to need a lot more working capital in the business. And if you can't either raise that money, bring it to the table, or get financing for that, then that can be a real struggle when buying a business, which can also kind of, again, devalue a business. There's a lot of talk about, you know, want to call it quality of revenue. So a lot of people will say that, you know, businesses that have reoccurring contracted revenue would be like a highest tier quality service, right? So think like subscriptions and stuff along those lines, you know, followed by where it's not necessarily contracted, but there's a lot of reoccurring revenue. So a lot of repeat clients coming back and buying the same service over and over and over again. And a lot of times like the lowest tier service would be something like, it's like one-off project basis where like everything is custom built. And it's the kind of thing where somebody only needs to buy, you know, one every 20 years or something along those lines. Then it's a lot harder to, you know, like people don't value that type of revenue as much. And so understanding kind of like the quality of the revenue, understanding those cash conversion cycles, understanding client concentration, those are all things that when you start digging into, you know, the financial statements are further going to refine, you know, where in that range of valuations you're ultimately going to try to apply to the particular business. So valuations are part math, part art, and part not letting a broker slick talk you into paying a 5x multiple on a pet rock subscription business. Yeah, don't do that. So now that you've crunched your numbers and figured out what the business is ultimately worth, I want you to go ahead and click my next video where we're going to go deep into actually making your offer and negotiating the business. I look forward to seeing you there.